Very happy to be here. My name is Rob Ashcroft. I lead our business advisory services team at Northern Trust. We're a national team, and one of our primary focuses is helping our clients hire investment banks. I used to be an investment banker myself for 18 years in London, London, England, Manchester, England, and Chicago before coming to Northern Trust 5 years ago to lead this team. So today I'd like to talk to you about investment banks and what are they and why would you consider hiring an investment bank. And I do hope that all of you who are CEOs of a business or own a business someday are fortunate enough to be in a position where you can hire an investment bank. Investment banking, there's two routes a company can sell stock or raise debt. One of them is independently, where you do it, the company does it themselves. So the CEO, CFO, often this happens with early stage companies where you have friend and family rounds. It's a very, all of this is very demanding on the management team, even if you hire an investment bank. But typically the smaller businesses have to do it themselves. And other times with larger businesses where you have a website, you can receive inbound inquiries. And in the investment banking world, we call those unsolicited offers. So you may get approaches from private equity houses, investment bankers, all sorts. If you have a website in this day and age, you're going to get inbound interest, and unsolicited offers are where it's got more than interest. So somebody's trying to buy you or invest in your business. The other way to do it is with an investment bank. So this is more for the established companies. And this is where they run a formal process, which we'll talk about. And look at the bottom, the context here, investment bank in our world is equal to the lead advisor or lead financial advisor, or the M&A advisor, or the corporate finance advisor. So there's lots of jargon, depending, but it all means about the same thing. So with that, here's an indicative landscape of investment banks. And we talk about bulge bracket investment banks being the likes of JP Morgan, Goldman Sachs, Barclays, Morgan Stanley. These banks are huge public companies that do everything on the left-hand side, from IPOs, capital raising, debt writing. They have sales and trading, market making, and full raft of things. They also have mergers and acquisitions. This is what we're talking about. If you're selling your private business, if you're selling your business for $30 to $1 billion private business, this is what we're talking about. They do restructuring and other things. And as you think about these investment banks, so Goldman Sachs will probably want to work on the sale of a private business where the business is worth more than $750 million to $1 billion. It varies depending on the M&A cycle we're in and how busy they are. So sometimes the bulge brackets move down into the middle market territory. If you look at some of these firms, if you think of KPMG, you may have heard of them. They're an accounting firm, one of the big four accounting firms. They also have a corporate finance group, an investment bank with about 80 people in it in the US, doing deals that range in enterprise value from $30 million to $200, $300 million. Yeah, you have a Brown Given Lang, which would be a boutique. Stout is an accounting firm. Moelis is a very large public company, but it just does investment banking, but it doesn't do the debt underwriting piece or doesn't manage money. Goldman Sachs manages money. So in that respect, Goldman Sachs competes with Northern Trust. Northern Trust doesn't have an in-house investment bank. We have boutiques. Yeah, boutiques are typically somebody like Focal Point, which was recently bought by B. Riley Financial Company, but Focal Point are headquartered in LA. And they have about 60 people, offices, LA, Chicago, right across the country. So there's a huge landscape here. So it's about picking one that is right for you. And these investment banks work on a success fee. So if they sell your business, they get paid a success fee. Lots of our clients say, Rob, I'm a champion negotiator. Why do I need to hire an investment bank? I negotiate all the customer contracts and everything. And I would say we looked at 4,300 transactions. half of them where the multiples were disclosed and half where the multiples were not disclosed. This is the EBITDA multiple. This is how we value businesses, often by what's the multiple of EBITDA. And what we found was where an investment bank was on the sell side, those transactions traded for a multiple which was 1.5 times more on the EBITDA. So if you have a business that's doing 5 million EBITDA, earnings before interest, tax, depreciation, and amortization, the language of investment banking and valuation, it's a proxy to cash flow. So if you have a business doing 5 million EBITDA, try and sell it yourself. Maybe you get 5 times or 5 times multiple. So you sell it for $25 million. If you hire an investment bank, you get a better multiple, 1.5 times more. So you sell it for 6.5 times, which is 32.5 times enterprise value. So that's a $7.5 million difference. And all you need to do is pay the investment bank $2 million to get that premium. And that sort of sets the thinking for the next slide later. So that's the justification for hiring an investment bank. They're going to get you a better value. And when we think about this on the same basis, we're talking about a $30 million transaction. So when to hire an investment bank? If the equity sale is greater than $30 million, therefore the company has an enterprise value, a deal size of $30 million. You want to be thinking about this. I would say that's the lowest point. You know, once you get to a $40 million enterprise value, you unquestionably really want to be thinking about hiring an investment bank. $30 million, it depends. You know, if you've only got one customer, maybe more difficult. If you're selling a minority stake in a company for, say, 30% of the company for $30 million, so the company is valued at $100 million, again, start thinking investment bank. In the venture world, when a company sells stock, normally what it does is it issues new stock to the new investors and dilutes everybody else. When you're dealing with companies that are more mature, that are making a profit, that are making 3 or 4 or 5 million of EBITDA or above, often some of the shareholders want to exit. So it's not as common for the companies to issue new stock when you hire an investment bank in the way that I'm talking about. The other thing is you may want to hire an investment bank when you're raising debt or mezzanine finance or debt, when the check that you're wanting, when you're looking for 40 million or more, because the investment bank still wants to make its minimum fee of about $1.5 million, $1 million, $1.5 million success fee. And when interest rates are where they are, that, you know, there wasn't much margin in it. But as interest rates start to go back up, more people will look to investment banks to raise debt. Yeah, because that investment bank's fees for raising debt has been pretty consistent for the last 20 years, but interest rates move around. Achieving the best price, advantages to hiring an investment bank. You're going to gain from their advisor's experience. Many people have only sold a business once or never. The investment banks, that's what they do. That's why they're good at it. It creates competitive tension, which is what you need in selling a business. Really important. Buyer access. Buyers read a lot into who is representing you. So investors, when they're looking at an opportunity, they look at the parties around it. It's like you should think of getting an audit as your business grows. It's what company does your company keep, which is very important for when investors are looking at you. Yeah. The other thing, investment banks have a very good understanding of buyers' behavior. Yeah. So all these things help the buyers increase the value of the business to get to that 1.5 times. Saying, what does the investment bank do to increase valuation by 1.5 times? It's things on this page. Yeah. Running a process. It allows management to remain focused on the business and running the business, which we'll talk about a bit later. So this is a formal sale process. This is a process that an investment bank would run when they were trying to sell your business. Yeah. So let's assume you're at 5 million EBITDA and you want to sell your business. Then the investment bank can take 2 to 3 months to prepare. The investment bank will create the story with you, the CEO, your CFO, and the management team. They will prepare marketing materials. They're very good at preparing all the glossy materials. They also know what investors want to see. That also drives valuation. Legal preparation is something you can be doing all the time. Yeah. So making sure you've got a data room, making sure you know where all your company documents are, making sure you know where your customer contracts are. All this stuff is just good housekeeping to have a data room and know where all this stuff is, because you're going to need it either if you're selling a minority stake, if you're speaking to a bank, a lender, or if you're selling 100% of your company. So this preparation stage can take a long time with privately held businesses where they don't have tons of resources because everyone's running the business. The investment bank will pull together a list of buyers and reach out. The investment bank will prepare the SIM. The investment bank will reach out to the buyers. You may have international buyers. We worked with a very well-known international bank, and in 2 weeks, they had approached 180 buyers all over the world, from financial institutions, private equity houses, strategic, trade, and everybody. So this is how you solicit interest. And off the information memorandum that the investment bank prepares, which is like a book, a prospectus on your business, you could expect if they went out, I'll talk about a project that we just worked on in the industrial product space last year. The investment bank went out to 160 buyers, private equity and strategics. We got 20 offers based on the SIM, the information memorandum. And the range of offers was the bottom of the range, $100 million, top of the range, $200 million. In that first round bid process, the ranges can be ginormous, and every offer is going to be a range. So it could be, I'm going to offer you between 100 and 120. Someone else could say, I'm going to offer you between 150 and 200. So there's often, and then the investment bank looks at all these offers, and these are all MBA kids and all different people coming up with this. So they've all had the same information, and they're all offering different numbers and ranges. The investment bank then talks to the best 10, and they actually brought 8 in for management presentations. So it's like the range. So now, and you bring in the investment bank, talks to the lowest and says, why are you down here? The investment bank is understanding why the highest offers are up here and what's wrong. Are they missing something? And then they steer the valuation a little bit, especially for the people at the bottom, the bidders at the bottom. And we had 6 management presentations. And then after the management presentations, an electronic data room is opened, and the bidders can re-bid. Yeah, so now they can get the chance to revise their offer. They see a sale and purchase agreement. They know they're in a competition, and this is when the offers increase. And then if you do everything right, and it's a really, in the healthcare space, it can be a really competitive process. And it also depends on the M&A market and your financials and how your business is growing. Really, the investment bank, if they're doing the job and the asset they're selling is right, they may be able to grant exclusivity to one buyer. And as soon as you grant exclusivity to a buyer, the seller has lost all the negotiation leverage. Yeah. And you've also had to let all these other bidders, you went to 160 bidders, you got 20 first round offers, you had 6 management presentations, you may end up with 4 second round offers, and then you try and negotiate with the best one. You may get 2 marked up sale and purchase agreements, and you negotiate exclusivity with the best one, and you may only need to give the final purchaser 1 or 2 or 3 weeks of exclusivity before the deal signs and closes. And you may even be able to get a simultaneous sign and close. And that's when you close is when you get the money. So this process, this formal sale process, is what drives the valuation and drives that 1.5 times extra multiple. And it gives you optionality through the process, which is really, really important. You don't know, am I selling 20% of my business, 50% of my business, 30, or do I want to sell to trade or strategics or private equity and roll some money over? Doing a formal process can elicit that sort of interest that gives the owners the chance to form a view. When you're thinking about your business and buyers, investors, depending on where the business is in the business life cycle, there's different buyer groups. Family members for a startup, family and friends round, business partners. If you're starting a business, often I see more success with startups where there's 2 founders or 2 people that are really can spar with each other than a single owner trying to do it themselves, because it's the most lonely job working a startup. So business partners, management team, even for mature businesses, a business with 10 million EBITDA. Sometimes the management team wants to buy it from the owners, yeah, so they can be a buyer. In startup world, angel funds, venture funds. In mature businesses, we talk about private equity buyers, family offices, sovereign wealth funds, and strategic and trade players. And sometimes a strategic or trade player could be owned by private equity. Yeah. Advisors in a deal. This is an important slide for you to keep in mind. And I've put in here typically a $50 million enterprise value, so $50 million deal to a $500 million deal. If we, there's going to be a lot of drinks if we get to a $500 million deal, but these are the advisors. Often the process is very similar, and the type of advisors you need is also very similar. So I've tried, this is just a proxy here. So you need your lead financial advisor who is going to be working on a success fee. If the deal doesn't happen, they don't get paid. That's why their fee is the largest in this table, because they also have an opportunity cost. If they work with you and fail to sell your business, none of the investment bankers get paid. Yeah. So when you're approaching an investment banker, they're sort of investing in your business. Yeah. So see, if you're going to approach an investor, if you're going to approach an investment bank, you've got to think that you're approaching a potential buyer of your business. Yeah. You don't want to give the investment bank projections that you're going to miss. Yeah. Because if you end up slowing down and you miss your projection, yeah, so there's lots of things you've got to, and they're looking at the stakeholders around the transaction, and the investment bankers are trying to judge the probability of close, because evaluation is important, but probability to close is important. And that all comes down to the information and quality of the business, the customer diversification. So these are all, and it looks like there's a lot of people, but there's no, when you buy a company, you don't get a warranty from the share. You don't get, you can't take it back. 30 days later, go back to Walgreens and return it. It doesn't work when you're buying a company. So you need all these people. A quality of earnings report, we can talk about that, what that is, but that's very, very prevalent now in the sale of private businesses in the US. And it's been the case in Europe for a long time. So good, the bad, and the ugly. Some of the things to look out for. I know Pepperdine did a study, and they found that when an investment bank is hired, 24% of the time those deals fail to close. So the investment bank doesn't get paid. That's often things out of the investment bank's control. It's like the company stops performing, the company loses a big customer. The investment bank told you your business was worth $150 million, and then you work out all the offers come in for $100 million. Hopefully in our clients that doesn't happen, because the investment banks will be well enough briefed. Sellers consistently underappreciate the amount of diligence and work associated with selling a business. Totally true. Yeah. You've got to think that if someone's going to give you $100 million for your business, and these people all work for private equity or a big corporation, they are all employees. They all have wives, kids, husbands, and they are doing a job. And if they suggest and accept and say, let's buy this company and go through with it, and then it doesn't turn out to be as they thought it was, they could lose their job, or they get demoted, or they don't get promoted. So everybody in the purchaser community, everybody is working for a job, and they all have to safeguard their assets, the cash for the shareholders or the investors. Yeah. So they're going to want to do a lot of diligence. Yeah. The other thing to watch, I've seen this. So there's a business in, it was acquired by Lowe's. It was in Houston. The first offer was around $230 million for this business. And then the shareholders decided to hire an investment bank. The investment bank got hired, a boutique in Texas. And then later, Lowe's bought the same business for over $400 million. Yeah. So that's what I'm saying when there was a comment. I mean, how does an investment bank, I've got a friend who, when I was at PwC, the first offer was from Xylem, a public company. It was for around $15, $20 million. And we got engaged, and we later sold it for north of 30, which is around 2 years later. So that's what I mean. This is where the value of the investment bank. Yeah. And every investment banker you talk to has one of those stories if they've been doing this long enough. And the other thing is, I would say, private equity. Private equity are professional buyers and sellers of businesses. So are VCs. When a private equity house sells a portfolio company, 95% of the time they will hire an investment bank to do it. Many private equity firms love buying companies where the sellers have no investment bank representing them, and they are the professionals. So what more do you need? Something that's in the US, there's more than 600 investment banks, sold one company or more last year. So there's a lot from your massive. So that slide I showed you with like about 20 on, we've interacted with 230 investment banks in the last 24 months. Yeah. And every project we do is different. Yeah. And every project and every business, so different set of issues, different part of the world, different sector, different geography, different chemistry, different customers, different buyer universe. So it's very much thinking about these things on the left-hand side. Doesn't need to be a local firm. Many of these, if it's worth $40 million, I had an aerospace business that was based in Connecticut, and our lead investment banker was in LA, and the team working on it was in New York, and the shareholder was in Florida. So it doesn't need to be a big business for you to bring a multidisciplinary team that's based all over the US or around the world. Yeah. This is how we can help you retain. You know, a lot of the other thing, estate planning, 50 and 50. If you're an owner of a business and you're approaching 50, you're over 50, and you think your business or your nest egg is worth about $50 million, make sure your estate plan has been revisited and you've had horsepower looking at it. But this preparing stage can be as long as, you know, it's always good to have plenty of time. Hiring the investment bank can take 2 to 3 months. We can help you with that. And then deal oversight, we'd stay around it and watch the investment bank. And then typically this takes like the 6 to 8 months. So closing thoughts, enhance the value of your business by always being prepared for a liquidity event. Lots of ways you can do that, even putting debt on your business. When we went through COVID and everyone got PPP money, those companies that already had a lending relationship were the top of the queue for getting the PPP money. Yeah, but it's good practice. A private equity house, if they're buying you, they're probably going to they will want to run the business with debt on it. Yeah. So just always being ready for a liquid is really, really good practice. Selecting the right investment bank is critical. When you decide to sell, do it with precision, understand what your process is going to be. Are you going to be approaching 30 buyers, 50 buyers? How are you going to do? Who are they going to be? Who are you going to approach at each of these buyers? The investment bank will tell you that and help you with that. And yeah, successful sale that maximizes, you know, this is what it's about. It's about maximizing net proceeds after the transaction. So with that, hopefully we're in the time, 25 minutes. So happy to answer any other questions or go to the comments.